Tesla told staff at its Berlin factory today that it's raising production again to 7,500 cars a week. That's the second 20% step up in a matter of months, and the clearest signal in a while that Tesla expects European demand to absorb a lot more cars. We've also got two regulators on two continents clearing legal ground for the Cybercab, a major new battery deal in Belgium, a blowout earnings report that briefly pushed another company past Tesla's value, and more. This is the Tesla Brief after the close on June 25th. Welcome to the show. A quick look at the stock. Tesla closed down 0.8% at $375.12, while the Nasdaq fell about 0.5% and the S&P 500 finished roughly flat. So Tesla lagged the market a little. And the reason that's worth flagging is the backdrop. Inflation came in soft today, oil dropped, and the 10-year Treasury yield fell to 4.39%, the kind of mix that usually helps a long-horizon stock like Tesla. It didn't today, and that gap is itself a story we'll come back to. Let's start in Germany. Andre Thiem, the plant manager at Giga Berlin, told employees today the factory will lift output to 7,500 vehicles a week, ramping from October, and hire another 1,000 people to make it happen. In his words, we will further increase production to 7,500 a week, starting to ramp from October, hiring another 1,000 employees. Here's why that's bigger than a single production number. This is the second 20% step up in just a few months. The first one took Berlin from 5,000 cars a week to 6,200, starting in July. Now they're going from 6,200 to 7,500. Stack those together, and Tesla has raised its European production capacity by about 50% in the space of months. A company doesn't add a second 20% step if it's worried about selling the cars. And that's what makes the timing matter. European demand has been the soft spot in the bear case all year. The registration numbers out of Europe are the figures skeptics keep pointing to. You don't commit to 1,000 new hires and a higher pace of production into a market you think is shrinking. There's a battery piece to this too. Thiem confirms substantial investment in 18 gigawatt-hours of 4680 battery cell manufacturing at the Berlin site, starting in 2027, with 1,500 jobs tied to that cell factory. Add it to the vehicle hiring, and you get about 3,500 new positions planned across cars and batteries. So this isn't a one-quarter blip. It's Tesla building physical capacity it only adds if it expects to use it for years. Europe's monthly registration data is the scoreboard. If Tesla is right that demand can absorb a 50% bigger pace of production, those numbers should start to confirm it over the coming months. And it lands at a useful moment, because Tesla's quarterly delivery figures print in about a week. More on that at the end. Next, a pair of regulatory moves that arrived on the same day, on two different continents, both pointing the same direction. The UN Economic Commission for Europe today adopted the first ever global rules covering fully autonomous vehicles. Those UN rules are the backbone of how cars get approved across Europe and a lot of non-European markets. They're not US law, but they're the path by which Europe, parts of Asia, and emerging markets actually certify a vehicle for the road. A country that adopts them now has a recognized way to approve a car that drives itself. And on the same day, here in the US, the National Highway Traffic Safety Administration formally removed the requirement for a manual brake pedal in vehicles designed to be operated only by automated systems. In the regulator's own language, it removes requirements for hand or foot-operated brake controls for vehicles designed never to be operated by a human. That is precisely the Cybercab. No steering wheel, no pedals. Now, the honest framing. This doesn't speed up the rollout by itself. Fleet size, the next version of full self-driving, and city-by-city approvals still gate how fast robotaxis actually scale. What changed today is the legal architecture underneath the whole project. The rules that would let a car with no wheel and no pedals legally carry passengers are now visibly being written on two continents at once. The thing to watch is whether Europe's approval path becomes the route Tesla actually uses to take the Cybercab beyond Texas. Staying on the energy side of the business, Tesla announced a new Megapack project in Belgium, partnering with a company called GIGA Storage. It's a battery storage facility with 2.8 gigawatt-hours of capacity, enough to help power roughly 385,000 homes, and one of the largest such facilities in Europe. The value is around $700 million, and Tesla owns the whole scope: the engineering, the construction, the battery supply, and the long-term maintenance. The detail that makes this more than another deployment headline is the hardware. This project uses Tesla's next-generation Megablock technology, paired with Megapack version 3, which Tesla says begins production in late 2026. So this is the first concrete project tied to Tesla's next-generation storage gear, and it pins that hardware's commercial debut to late next year. Put it alongside a $5 billion European Megapack deal flagged earlier this week, and Tesla has announced more than $6 billion of new battery storage projects in just the past few weeks. The energy arm is signing the kind of multi-year, infrastructure-scale contracts the car business simply hasn't. Now to something happening outside Tesla that lands right on its doorstep. The memory chip maker Micron reported earnings, and the results were a blowout. Revenue and profit well ahead of expectations, guidance raised sharply, and the stock jumped more than 14% after hours. At one point today, Micron's market value briefly passed Tesla's. That's worth pausing on, given everything we just said about Tesla lagging while the rest of the market runs. But the part that matters for Tesla directly came from Micron's chief executive, Sanjay Mehrotra. He said humanoid robots carry 10 times the amount of memory as an average advanced driver assistance vehicle, and that he expects a sustained, substantial, multi-decade memory demand cycle to begin in the latter part of this decade, tied to robotics. That's a supplier, someone who actually sells the parts, putting a number on the Optimus opportunity. When the company that would actually sell you the memory says humanoid robots need 10 times as much of it as a car, that's real validation of the robot story. And it comes from the one corner of the market with no reason to hype Tesla. There's a flip side though, and it showed up at Apple the same day. Apple raised prices on its Macs and iPads by as much as 15 to 20%, and was unusually blunt about why. In its own words, the rapid expansion of AI data centers has created an extraordinary surge in demand for memory and storage. We've never seen a component price increase this much, this quickly. Tim Cook told the Wall Street Journal it was the biggest jump he's seen in over 40 years. Here's what it means for Tesla. Tesla buys enormous amounts of memory and storage for its training computers and for the chips inside the cars. If that component cost is spiking fast enough to push up the price of a laptop, the same pressure is hitting Tesla's data center buildout and the parts bill on its AI4 and AI5 hardware. It's the kind of thing worth listening for on the next earnings call, whether Tesla flags rising component costs. The same memory shortage that validates the robot opportunity could, in the near term, make building the brains for those robots more expensive. That brings us to the most coherent, cautious voice on Tesla right now, Gary Black, who runs the Future Fund. He laid out 3 connected points today. First, he reiterated his cautious stance, citing falling earnings estimates, a stock he sees as expensive, and what he thinks is coming next in self-driving. Second, that last point, his argument is that unsupervised autonomy is becoming commoditized. He notes that Google, Baidu, and several others are now collectively completing about 1 million paid driverless rides a week with no safety monitor in the car. His conclusion, driving itself is turning into table stakes, the way advanced cruise control already has, something everyone offers, not an edge. His third point was the sharpest. There's a bull theory floating around that Elon is deliberately slow-walking Tesla's robotaxi rollout so that SpaceX can later buy Tesla cheaply. Black called that absurd, and the reason is worth understanding in plain terms. SpaceX is valued far more richly than Tesla, relative to its earnings. So in a deal where the two companies swap shares, Tesla shareholders would end up owning a much smaller slice of the combined business, the opposite of a bargain for them. The logic of the theory just doesn't hold. To be fair, this is one side of a real debate. The bull counter is that Tesla's camera-only approach and its global fleet of millions of cars feeding back data make any talk of commoditization premature. Tesla, they'd argue, is playing a different game than a few thousand mapped robotaxis in a handful of cities. We don't make the call either way. But Black is putting his finger on the thing today's price action illustrates. Over the past year, Tesla is up about 10%, while the Nasdaq is up around 32%. The macro tailwind we mentioned at the top, soft inflation, lower yields, is helping the market, and it isn't translating to Tesla. That disconnect is the open question on the stock right now. A couple of quicker items to round things out. Tesla's VP of Vehicle Engineering, Lars Moravi, flagged that J.D. Power unofficially ranked Tesla third in initial quality across the whole U.S. auto industry, and first in its EV experience score. The word unofficially matters. Tesla doesn't formally take part in J.D. Power's rankings because it doesn't grant the access J.D. Power requires in some states, so it shows up as unranked in the published table. But the underlying owner survey data still places it third on quality and first among EVs. It's a modest signal, not a thesis mover, but it's exactly the kind of point Tesla will lean on against the quality and demand bear case heading into deliveries. And one competitor just left the field. The U.S. Department of Commerce refused Polestar permission to sell new vehicles in the United States from the 2027 model year onward. The reason is the connected vehicle rule, which bars cars whose connectivity hardware or software trace back to China. And Polestar is majority owned by China's Geely. The ban even covers Polestars assembled in South Carolina. Polestar isn't a volume threat to Tesla, but every premium electric nameplate that disappears from U.S. showrooms is one fewer alternative for a Model Y or Model S shopper. And the bigger pattern is that this rule will bite more China-tied brands as the restrictions phase in. And Tesla, structurally, is the biggest beneficiary of that wall going up. Which brings us to what everything this week is really pointing at. Tesla's second quarter delivery and production numbers land in about a week, around the 1st of July, and that's the biggest near-term event on the calendar. The setup going in is loaded. Wall Street's forecasts have been creeping up, with at least one major bank now sitting above the consensus. The Berlin step-up today says Tesla expects to absorb a much higher pace of production. The J.D. Power numbers hand Tesla a quality talking point. Against all of that, Gary Black is pointing at falling earnings estimates and saying the growth challenge story still has teeth. The delivery number is the first hard data that starts to settle the argument. Then the full second quarter earnings report, expected late July, answers the rest. Auto and energy margins, the robotaxi fleet, the timing on the next FSD variant, where Optimus production stands. The real question for late July is whether Tesla guides to a genuine robotaxi or Optimus ramp, or whether the numbers confirm the bear read that earnings are still drifting lower. Delivery set the table. We'll have the full breakdown the day they land. That's the Tesla brief for today. If it's been useful, please subscribe. Thanks for joining us, and we'll see you in the next episode.